What is the one big beautiful bill, and why should real estate investors pay attention?
Some of the biggest changes in recent history. I think it's going to be a good thing for most people. Again, we're going to have clients that are being aggressively going out and buying more real estate at the second half of the year.
There's not a right or wrong way to invest in real estate. I think for anyone investing passively, the bare minimum you want to do is just a keyword search in Google, right? So search their name and fraud, right? So John Smith and fraud, John Smith and SEC, John Smith and complaints.
In this episode of the Passive Income Playbook on the Best Ever CRE Show, we are sitting down with the powerhouse CPA duo Amanda Hahn and Matt MacFarland, tax managing directors at Keystone CPA, co-authors of the tax strategies for the savvy real estate investor, have been passive investors for over 20 years across everything from mobile home parks, apartments, and self-storage facilities, and having built their own long-term rental portfolio of single-family homes and condos. On top of that, if you are a passive investor or a syndicator trying to understand what's changing with depreciation, 1031s, entity structuring, this episode is going to be a great breakdown. And with that, I'd love to welcome Amanda and Matt.
Yeah, super excited to be here.
Yeah, thanks for having us.
Yeah, so I'm excited to have you guys on the show. I'm excited to have someone break down what we should know about the Big Beautiful Bill. But before we get to that, what I want people to understand is a little of your background. You are LP investors yourselves. You're also active investors. Help us understand how you got to this point, and we'll dive into that.
Well, what I always tell people is I'm a CPA by day and real estate investor by night. So like a lot of our audience, we still have our day job, which is managing our firm. And I actually grew up as a third generation of real estate investors. So my grandparents did real estate, my parents dabbled in real estate, and I thought I would never invest in real estate because I grew up with my grandparents being very hands-on in managing their portfolios. But it wasn't until I started my career in public accounting where I worked with real estate investors that I actually saw it from the wealth building side rather than the nitty gritty property management side. And that's what kind of got me at least started down this path.
Yeah, I also worked in Big Four accounting. I think I always remember my aha moment. I was probably second or third year into being a tax associate or senior and working on an individual's tax return. He was probably in his 60s. He was retired and he had a portfolio of real estate, right? And you can kind of figure out by looking at the return that this guy was making at least six figures in cash flow and not paying any taxes on it because of depreciation and other things. And that's kind of when the light bulb went off, like, oh, there's something here. And since then, it was kind of like, hey, we like this real estate thing. And so our firm right now focuses on working on real estate investors, runs the gamut from people who are just getting started to people who are full-blown investors who have scaled, successfully over the years and everything in between. So it's what we know, it's what we like. So we're excited to be here.
Love it. Okay, so you are both active investors, have your own portfolio, and invest as LPs. Talk to us about that, pros, cons, why, what you've learned.
It's funny. We were just interviewed for Business Insider, and they were asking us about the same exact question. This is the same thing that I tell clients as well. There's not a right or wrong way to invest in real estate. There's not one is better than another. At least for us, our investment strategy changes throughout different seasons of our lives. When we first started, we were working full time. We didn't have a lot of money to invest. And so we were very active. We did house hacking. We did the whole BRRRR strategy, single family homes, and eventually built it up. And now we're in a place where we have more funds than we have time. We also have two kids who are a handful. So for us, being able to leverage the expertise of other real estate investors who know more than us with larger deals makes more sense at this point in our lives. So yeah, it's not like a right or wrong answer. It's just which time point in your life does this specific investment make more sense for you?
Yeah, and I think that for us, that's for sure. It's the leveraging other people's expertise because they're a lot more, they know more hands-on of doing the big deals than we would ever know, and so that's where it just makes sense for us to leverage that at this point in time.
Yeah, and then how did you decide to go across all different asset classes?
We have a unique vantage point in being CPAs who work with real estate investors, in that we see what our clients are doing, we see who is successful. So from that perspective, obviously we're numbers people. So for us, even though we might not understand the nitty gritties of a specific investment product, but we do see the numbers, and that's what dictates a lot of how we make our investment decisions, as is what I would recommend for all of you who are investing passive.
Yeah, it's crazy. So this is a very interesting topic. I've interviewed anyone from mortgage brokers who see all the time the types of deals that operators are putting together that they need mortgage products for. So they have a unique vantage point. This is also a really interesting one. I'd love to, just spend a couple minutes here and really dig into what that kind of looks like. Like, I imagine you see a lot of deals or K1s that are not great. And then I imagine you see great ones. And is that like just a pattern you see over time? Or is it like, I am looking to invest, I have 50K liquid, I've started seeing that these operators crush it that are coming through. And then it's like, then you go dig into research from that perspective. How do you take advantage of the unfair advantage that you have?
For us, like I said, we see the numbers, right? And the one place where people will not overstate their income is on a tax return, right? So you might be telling investors you're doing great. That might be an inflated number. You might be on stage saying you're doing better than otherwise, or even to a lender, right? We might have different number we're telling the lenders, but to a CPA, you never, or I don't want to say never, but almost never inflate income. And so what we see are, generally going to be a very accurate reflection of what the deal's doing. But for everyone else, our listeners who don't have that unique advantage point that we do, I always tell clients, put very heavy emphasis, not just on the deal itself, but the sponsors. When you're a passive investor, a lot of how well or not well the deal is going to be dependent upon the expertise and the integrity of that sponsor. So do your due diligence on the deal team just as much, if not more, than the property itself.
I think for me, something that comes to mind too is along those same lines is being, I don't know, anal retentive accountant, as I'll call myself, is very detail oriented, right? So you see, clients passive investors that are clients of yours will say, hey, I'm looking at this deal. Like, we're not doing the due diligence, but just they're asking us, what do you think? Like, what questions should I be asking? And we'll look at some of the stuff. And it's like, it can be, within 30 seconds to us, we can tell quickly that this operator may not be very organized. And so that's a bad sign right there that, a year into the deal, you're not going to get financial statements when you ask for them, or if you get financials, it's going to be 3 different pieces of something trying to be put together. And so that's another sign for us is like, the lack of organization can be a big red flag. So another part of the due diligence is on the operator itself.
All right, we're going to get back to the episode here in just a minute, but I'm going to take a pause here and talk directly to you. If you are a retail accredited investor in commercial real estate and you are seeing fewer than 10 deals every month, you are not investing, you are gambling. You are having a blind spot. And if you're gambling with your money, sooner or later, you are going to lose. The pros don't play blind. Institutions will look at hundreds, sometimes thousands of deals before investing in the top 1 or 2%. And that is why they keep winning while most individuals are left with average returns at best or devastating losses at worst. Now, I'm an LP investor just like you, and I had to solve this problem for myself. And today, I now get flooded with hundreds of deals every single month. And using that deal flow, I've now invested over $3.3 million across 23 deals. And now those investments generate my family over $100,000 a year in passive income. Now, here is why that is relevant to you. I've packaged all of that deal flow into a free starter kit so that you don't need to play blind anymore. Inside, you'll get at least 25 current opportunities that are updated every Friday, plus some education about the exact system I use to filter out the losers and zero in on the winners. The best investors don't win by working harder. They win because they see the deals that no one else does. And this starter kit puts you on that side of the table. And you can claim your free copy at passiveinvestingstarterkit.com and start seeing the deals that the pros are seeing. Again, that is passiveinvestingstarterkit.com. www.passiveIncomePlaybook.com. And with that, let's dive back into the show. What kind of due diligence are you doing? So like, give me the last deal that you've done. It's like you see these different, I imagine you have a list of 100 different operators that you maybe, if you're seeing all these tax returns, and then you kind of pick the top 5 and you go look at their website and like walk me through what that process looks like.
Yeah, I think for anyone investing passively, the bare minimum you want to do is just a keyword search in Google, right? So search their name and fraud, right? So John Smith and fraud, John Smith and SEC, John Smith and complaints. I know people laugh at it, but I think a lot of investors don't even take that step. And even starting out for us too, one of our first passive investments with our own 401k. I know a lot of our listeners probably know how to do the whole self-directed. And our first investment was just this guy who was on stage, and he really resonated with us, and he was doing great things. We eventually lost all of that money because it was before we understood how to do due diligence. So those are just some simple things, right? Look online, look to see what kind of feedback review. I don't really care how great you did. I want to know all about the things you didn't do so well, and how did you interact with those kinds of things. And of course, just speaking with other investors too. For us, we are fortunate where we have clients who invested with these different deals. But for those of you who don't, reach out to other investors within the community and figure out how are these sponsors? Are they communicative? Are you getting distributions? Right now it's been a tough season for a lot of syndications, especially in the multifamily space. So the things we're looking at is, are you being honest and apparent, transparent with the investors, right? How do we
their
handle
integrity?
how do we handle hardships in the not so good times?
Yeah, I hear that. What have been maybe some, as you go through this process, have there been any surprises, any clear red flags that come up as you go through this? I guess what I'm trying to pull out here is I hear a lot of the same things from investors. And so like, is there something unique that you do as CPAs that other people do not?
That other people do not. I think most investors don't ask some of the more important questions, right? Again, what I mentioned, like in hardships, what happens in certain scenarios? Just being knowledgeable enough to ask those questions. I think, again, we have an unfair advantage, right? What are times when there's not enough money for distributions? How much are you holding back for a cushion in downtimes, right? How do we get out of this balloon payment? If that's what we have, some kind of bridge finance. So not to say you have to understand what all the answers mean, but as a passive investor, it doesn't mean that we're purely passive and that we don't do anything. We just give them the money. Before we give them the money is when the hard work is done, right? Different than an active investment. We do a lot of work up front. And also during in the property management. In this case, more of the heavy lifting is done earlier in the investment cycle.
Yeah. Okay, cool. Love it. Thank you for sharing. I always just kind of like to dig in a little bit and have other LPs learn from how other LPs are digging in and doing due diligence on these deals. But that, I think, would be a good transition to talking about the one big beautiful bill, which I imagine as CPAs you need to study, learn, and kind of understand the whole piece to understand how it affects or will affect your clients, but you also for yourself as an LP, which I'm sure makes it that much more impressionable. I would love for you to kind of like maybe set the stage for before we even dig into what changes are in the big beautiful bill, as a CPA, when you hear about a type of legislation like the one big beautiful bill come out, how close are you following that type of thing? Do you not really follow it until it's gone through Congress and been signed, because it might change historically so many times? Walk me through, like, from the vantage point of a CPA, what that process looks like.
I think the answer is going to differ from CPA to CPA, maybe even between Matt and I. We might have a different answer. For me, I always like to stay on top of things. So yes, even in the proposal, if there's whisperings of specific tax changes or proposals, I like to keep my eye on the ball. I think for 2 reasons. One, a lot of our clients are pretty savvy on the tax side of things. Maybe part of it is because we've trained them well and they actually care. So they're often texting, emailing us when they hear something as well. So, for us, we have to be knowledgeable. And also, the earlier we know of potential changes, the earlier we can start the planning and the strategizing for that specific change.
Yeah, I think from a CPA's perspective, with the one big beautiful bill, at least they have been talking about that for 6 months, and so from our perspective, it was nice that it finally got to the finish line, because it does give us that opportunity to start talking, having those conversations, do the planning. Because there was tax changes passed years ago that were passed like December 30th or something, and it's like you can't do anything with that, like obviously. So yeah, we stay up to date on it, because we want to know when it's going to cross that finish line, and what can we do to help our clients once it gets there.
And I will just share, I do get yelled at by other CPAs that, not in our firm, where they'll say, hey, you're sharing so much information on social media about potential changes. Let's just stop talking until the actual change occurs. But like I said, I think a lot of investors, they want to know. They want to know what's going on, and we kind of want to follow the process to see what the outcome is.
Yeah, and this was maybe I don't know if it's unique, but less common that everything is passed in one big package. Usually these things are done piecemeal. And I mean, what I heard you just say is like sometimes they're brought about on December 30th, and you can't do anything that fiscal year really. Talk us through that. Is that how? I imagine that makes it very difficult to kind of work with clients and advise them if they're coming out like that.
Yeah, and I think that this administration was more aware of that, right? The last time, like Matt mentioned, we've had things passed near the end of the year. And if you think about it, the bulk of what they're trying to pass with respect to tax changes is to incentivize certain action, right? So we'll talk about bonus depreciation, I'm sure, but these credits, these benefits and incentives are designed for us to take certain action. And I think in the past, when the tax law is effective so late in the year, investors as well as large corporations, it's almost impossible for them to react and make those improvements, make those investments so late in the game. So I would, I guess what I would assume that this administration is aware of that timeline and impactfulness of when it comes out. That's why they've been very aggressive in trying to give us at least half of a year, right, to try to reap these new tax benefits.
So, okay, very, very helpful context. I'm always wondering like how different industry players react to this kind of thing. For those who have not been following closely, can you just kind of give us an overview? What is the one big beautiful bill, and why should real estate investors pay attention?
Yeah, it's a great question. I think from looking at it, it's probably, in our opinion, kind of some of the biggest changes in recent history with respect to taxes. And there's benefits for individuals, there's benefits for business owners, there's benefits for real estate investors. So that's why I think it's, and to Amanda's point, it's no surprise that President Trump favors real estate investors and business owners, obviously, right? So from that perspective, it's kind of in line with what you would, to some extent, what you'd expect, right? But yeah, it's a good thing. I think it's going to be a good thing for most people. Again, we're going to have clients that are being aggressively going out and buying more real estate at the second half of the year. That's our expectation, at least.
Yeah. Okay. So talk us through like what are maybe high level, what are the big changes that we can go through kind of one by one and talk about its impact for us as investors and how that might change the way we invest?
I don't know that it would change the way we invest. Obviously, if we're talking real estate specific, 100% bonus depreciation being, reinstated is a huge or a significant change. So prior to the signature of this new law, 2025, we were looking at 40% bonus depreciation, which is not terrible. But now that 100% bonus depreciation is brought back, for a lot of our investor clients, tax benefits just more than double on the same exact piece of property, right? So if you had a property where we're thinking $1 million of first year depreciation, now we're looking at over $2 million of depreciation. And so that really impacts how we plan out for the rest of this year. Maybe I was expecting to invest in 5 different syndications to get the tax savings. Now I only need 2 or 2.5 to get to that same ultimate tax savings. If I am a sponsor and I'm syndicating a deal, if I had projected tax benefits for my investors earlier this year, I might want to go back and update my projections because now they could expect a whole lot more in tax savings. So those are the kinds of things that we're doing within our firm with clients to try to figure out, okay, what are some of the things, if you have a W-2 job, do we adjust your withholdings? Do we pay less into quarterly taxes? Because what we always want to avoid is overpaying the government during the year and then have to wait endlessly for a refund. And especially with IRS, slashing their headcount, the refunds are coming in slower and slower than ever before.
I think on the sponsor side of things, one of the things that it's not new, but it did get basically extended or, continued on with the One Big Beautiful Bill is the pass-through entity tax break. So for those sponsors out there getting kind of syndication fees and making active income on the side from putting the deals together, to the extent they're going to have profit and have to pay state taxes, personally, now the entity can continue to pay those state taxes for them, and it doesn't get limited on the personal side like it would for normal state taxes. So this is a way for, if somebody the entity has $100,000 profit and owes $10,000 in state taxes, the entity can pay it, and then you're going to get a federal deduction, which would save them a lot of money, a lot of federal taxes there that they would be limited on the personal side if they try to pay that tax personally. So that's a good benefit from the active side of things.
So taking a step back, talking about depreciation in general. So like depreciation is this concept where building you has depreciates over time. It requires repair. It doesn't improve. It takes maintenance to keep it up. And so on the accounting side, we get to write off some of that depreciation as an expense. And what bonus depreciation does is allows us to write off significantly more of that expense in our first year and pull those expenses forward to incentivize investors to invest in real estate. Do I have that correct? Any changes you would make to that?
Nope, you got it. And so the incentive is, acquisition, obviously, right? If I buy more real estate, I theoretically get more depreciation through accelerated depreciation, through bonus depreciation. But also for a lot of our clients who own multifamily, or even just single family too, it incentivizes us to do more improvements, to make the properties better. Why? Because even in improvements, oftentimes we can do accelerated depreciation to pull more of that tax benefit forward to today rather than having to wait over the next 5, 7, or 15 years.
I think one way to look at it too is it's going to opportunity to kind of shelter more cash flow from taxes sooner and maybe quicker. So that's going to help the investor who are getting those distributions but not having to pay taxes on it.
Do you have any insight or can speak to about why the government is incentivizing us to do that?
It's to stimulate the economy, right? So for business owners, it's if we can write off more rather than having to wait for the write-off, maybe I am incentivized to spend my money sooner. For real estate investors, it's a similar concept, right? If I give you more write-offs, then you're more open to adding to your portfolio. If I give you more depreciation, you're more willing to make improvements to the properties and make better living conditions. I'm providing housing. So I think like what Matt was mentioning, for a lot of our clients, they were waiting to see if 100% bonus comes back because it impacts how much more they want to buy in looking at not just the cash flow and appreciation, but now adding the significant tax savings on top of it too.
So I imagine you as CPAs have a very close eye on so bonus depreciation, you can obviously write off significantly more expenses. There is this concept of depreciation recapture, where at the end of the cycle of a deal, you sell the building. And so because normally the building is depreciated over 27 years, now you've pulled a lot of that forward and the government wants to recoup some of that depreciation because you sold it before completely depreciated. Can you talk to us? I've never, spoken to a CPA and heard their point of view about maybe the missteps or the common misconceptions around this. Like, tell us what depreciation recapture is and what some of those pitfalls or things we might not think about when it comes to investing in deals with a lot of accelerated depreciation.
Yeah, I mean, depreciation recapture is just kind of the IRS saying, like, you buy a property for $500,000, you got to take $50,000 of accelerated depreciation as a deduction right now. So that's your benefit. But when you go and sell it, your basis is now down to $450,000 because you've got that benefit already. So when you sell it, that first $50,000 of gain is going to be depreciation recapture with air quotes. So they're just saying that that's going to be taxed at a certain rate. Sometimes it's 25%. Sometimes it could be higher depending on the taxpayer's tax bracket at the year's sale. But what we tell our clients is, you want to be aware of depreciation recapture, but it's not the end all to be all. It's not the thing that should be driving your decision now for what's going to happen maybe 3, 5, 10 years down the road. There's a lot of things you can do on the back end on the sale to minimize the effects of depreciation recapture, allocating sales price of certain items. Maybe that 5-year property you just depreciated has no value 5 years later because it's been 5 years, and so there's nothing to worry about there. So there's a lot of moving pieces. So it's more of just taking advantage of what you can right now and plan for the future as pieces are moving.
And one thing that really bothers me a lot is actually CPAs and other tax professionals will talk about depreciation recapture as if it's like this really bad thing, like don't take depreciation because of recapture. And that's actually very terrible advice because depreciation itself is not a choice. You are required to take it. And even if you don't take depreciation, when you go to sell the property, the IRS could still assess recapture as if you would have taken depreciation. And so, as long as you're planning ahead, there are always ways to potentially eliminate the impact of depreciation recapture. For a lot of our passive investor clients, if they weren't able to use the depreciation and just regular rental losses in the years of holding an asset, well, guess what? When they sell the property, all those accumulated losses are freed up and they help to offset the capital gains on the sale of the real estate. And that includes offsetting the depreciation recapture. So it's not the doom and gloom that a lot of people make it out to be.
Yeah, I think my big concern or something I'm trying to be weary of is, everyone's going to be shouting at the rooftops, hey, our deal has 100% bonus depreciation. You can write off X amount. And I think retail investors, myself included, don't fully understand what depreciation recapture even is, right? I think it kind of shows up at the end and then you realize like, oh, I actually need to roll this money into a new deal, or I need to, when you're investing in a deal, I don't want to turn a blind eye to the idea that, okay, I am taking a bunch of depreciation up front, which was not previously allowed. So what is the opposite thing that I need to now pay attention to? Because, there is recapture. So what should someone just know about recapture as they start investing in these deals that offer accelerated depreciation?
I think for me, it's about not planning just for today, but doing long-term tax planning. Right. And so when a deal is to be sold, and this is a tip for those of you who are actually the syndicator or the sponsors, is in communication before the deal exits. As soon as you know it's going to exit, have that line of communication open with your investors and let them know, right? We're selling, the deal did very well. Here's what you can expect for your share of taxable gain for this year. And when you let your investors know that earlier on, then they can meet with their CPA and pre-plan and plan ahead, right? Which is, I think, what you're alluding to. Well, if I know I'm going to have $100,000 of capital gains, which includes the depreciation recapture, what are the things I could do to alleviate that? And that starts with a conversation with your personal CPA, because they'll be able to help you say, okay, well, you've got some passive losses. Maybe we don't have a worry. You just cash out and, go sit on the beach. Or maybe it's more similar to your situation of what, you were saying, where while I have a gain, I don't have a lot of other losses. So what should I do? Should I do a lazy 1031 exchange and invest in other syndications to offset this expected gain? Or maybe I just buy my own rental properties if I feel inclined, buy my own property on Main Street, get depreciation, offset this gain. So as long as you have sufficient headway to plan, usually it works out okay. But if you don't really know that you had a gain until December, oftentimes it's hard to deploy that strategy in the last 30 days of the year.
So what I'm hearing here is as an LP investor, people typically think like, oh man, I have to write off this amount I need to invest this much because I'm looking to write off X amount in taxes. And they may choose a vehicle to do that. And really, when we're talking about depreciation recapture, it's more about understanding when is the deal that I'm in, when is it going to exit, and then trying to understand, like the moment I know that as an LP, I should be reaching out to my operator if they haven't told me already and try to understand what kind of capital gain there is going to be so I can maybe try and plan around what am I going to do next? When am I going to get that capital? Is it going to be in July or is it going to be in December? How much time do I have if I need to invest in another deal? Do I have that right?
Yeah, no, that sounds right. Yeah, because the depreciation recapture, as Amanda said, is part of your capital gains calculation. And some buckets of that are just going to be taxed differently. And so that's part of that conversation with the operator is like, hey, what's my share of the gain? What's the breakdown of it? I go and talk to my personal CPA, plan for the rest of the year. What are we looking at in terms of numbers? What can we do? What are the options? Is it reinvesting? Is it making a donation somewhere? Different things you could do, right?
Yeah. Okay. So we've covered now. Bonus depreciation is back. It's back at 100%. What does? What are the next? What's the next item on the list?
I do want to say something before we move on for bonus depreciation. So the new law is the 100% bonus is effective for properties that are purchased and placed in service after January 19th, 2025. So if you've invested in a deal where the acquisition date was prior to that date, then you might not be able to use the 100% bonus depreciation. Now, if I bought a property years ago and I've done improvements this year after that effective date, I do get to use bonus depreciation on the improvements that were done, but just not on the building if the building was purchased prior to that date. So something to keep an eye out for, depending on purchase date and place in service date. I think a lot of the other things in the one big beautiful bill, besides what Matt said about qualified business income deduction,
PTE,
or pass-through entity tax break is obviously a huge one. Since we're talking about the exit, right, of real estate and depreciation recapture, just another tip here is that if you're working with a savvy sponsor, to the extent there are capital gains taxes that are due at the state level, it oftentimes makes sense for the entity, the fund, to make that election so that the entity can pay the state taxes on our behalf for all the investors and therefore turn it into a business deduction, right? Rather than if the entity didn't do that, now it all flows through to me. I personally pay tax on it. I can't write off as much of that without the limitation.
So what do we do as an LP, right? I mean, I think we would be expecting our GP to handle this. Is this a question that we should be sending all of our GPs that we're in deals with? Is this?
You could. Yeah, you certainly could. It doesn't hurt, right? So if you have an LP investment that is expected to exit, or for any other reason, you're expecting to have taxable income from that real estate syndication, when they were saying like they'll tell you your share of profit, your share of gain, right? If you ask them. And so if they tell you the share and part of that is associated with a specific state, you can always ask them, does the entity plan to make the pass-through entity tax election to withhold and pay taxes on our behalf? Now, as an LP, you might not have say in it. It just might be, it is what it is, what they tell you. But it also doesn't hurt just to ask.
Yeah, definitely. Okay, what are the other changes we should know about as a passive investor in the one big beautiful bill?
I mean, I think from an individual, just an investor, taxpayer perspective, the one thing that I think people should be aware of is with respect to state income taxes and property taxes on the personal side of things, that deduction used to be capped at $10,000 has now been basically 4x. So the maximum deduction now is $40,000 when you combine your state income tax and property tax on your personal residence. So I think that's going to be a big change. I mean, we're obviously in California where you can get, some people we can get close to $40,000 in property taxes alone, I'm guessing, right? So, but a lot of our clients were getting haircutted on that deduction over the last 7 or 8 years. So that's going to be a nice benefit for a lot of investors and taxpayers out there for sure.
When we do tax planning with clients, there's a concept we use that we call strategy stacking. So it's where you take one tax strategy, you lay on top of another one, right? So we talked about depreciation, that's the baseline. Accelerated depreciation is the next stack, and then bonus depreciation is the third. With the one big beautiful bill, what came out was a lot of brand new tax breaks and new benefits. Not really for real estate specifically, but peripheral to real estate. So for example, if you're a syndicator and you have people working for you, right, part of their overtime income could be tax-free. If you are someone who works overtime, part of your overtime income could be tax-free, part of your tip income could be tax-free. But as with anything in the tax world, a lot of these come with income limitations. So oftentimes you have a taxpayer who says, you know what, that's all great, but I make too much income to get any benefit for all these new tax breaks and tax credits. But another way to look at it is, well, what if naturally my income was too high, but instead I invested in real estate? And if I invest in the real estate where I'm able to use some of these tax benefits to offset my other income, then maybe that brings me down to a lower threshold where I can get more of these tax write-offs, of child tax credits, and just other things I was naturally not able to utilize in the past. So for us, not specifically to passive investing, but just real estate in general, right? Probably more applicable if you're more actively involved. But being able to use some of these real estate tax perks to lower your effective income and then be able to qualify for some of these new tax benefits.
I'm also, there was a lot of talk about opportunity zones, and could you shed some light on changes, or maybe lack thereof of changes, that we're maybe still waiting to see around opportunity zones? Or maybe, okay, describe what opportunity zones are, and then go into it.
Yeah, opportunity zones came about from the last tax bill at the end of 2017. But basically, we've had your audience be very familiar with 1031 exchanges. We've had that for years, where you sell one piece of real estate, you buy a replacement property, and you're deferring the taxes that you were going to owe on the property you just sold. The opportunity zone allowed people they can still use it with real estate, but now it was allowing people to kind of sell other things for gains, like stocks or maybe a primary residence, and reinvest those gains into real estate or an opportunity zone business. And so it was allowing more people to kind of reinvest their stuff into real estate and businesses. Now, the one big beautiful bill, the nice thing about the opportunity zone, it was extended. There's another kind of 10-year window moving forward, so people can start utilizing opportunity zone deferrals again starting in 2027. The one thing we were hoping was going to get included in there was people who have utilized opportunity zones before and deferred taxes. Those taxes are coming due at the end of 2026. We were hoping that was going to get pushed back, but that was unfortunately not included in the bill. So that was just, hopeful thinking on my part, I guess. But
yeah, so we have what we call a dead zone right now. So, if you're investing in ozone now in 2025, you get to defer for just 1 year, right? The deferral part. And so it's not as attractive as it was, 5-7 years ago. So one of the things that we are strategizing on is for our clients who do expect that kind of gain. Matt mentioned sale of stocks, sale of real estate, but also sale of businesses. So we have a lot of clients who are business owners. They want to get into real estate, but obviously you can't 1031 exchange a business to real estate. So we're strategizing on whether how do we defer the gain for a little bit, maybe into 2027, so that we can then use that additional, the newer ozone rules to try to get a little bit more deferral rather than just a 1-year deferral. So some of the fun stuff that's happening.
Yeah. Has anything around Delaware statutory trusts changed, or can you walk us through a little bit of that?
No real change from the One Big Beautiful Bill. Just, from a definition perspective, Delaware Statutory Trust, often referred to as a DST. Typically, we see that in use for someone who sold a piece of property and maybe wants to get into more passive real estate syndication, where the traditional syndication LLC structure won't allow for a 1031 exchange. So you often have times where sponsors will set up their funds and use the DST structure rather than the LLC structure to allow an investor to sort of 1031 exchange a piece of property into a partial ownership of a larger deal. So, it's a pretty niche thing. There hasn't been any talks of changing it. Unlike the 1031 exchange, which is basically on the chopping block with every election term, I've not really ever heard anyone talk about getting rid of the DST loophole.
yeah, so the nice thing is it's still an option for in the right situation for sure.
Yeah, has there been anything around the One Big Beautiful Bill that has maybe shifted the way that you think about investing for this or upcoming years?
Like I said, I think for our clients, the bonus depreciation is going to be the big piece. For those people who maybe there's passive investors looking to invest in deals like these. There's operators listening to this who are doing that, but they did part of the One Big Beautiful Bill. A brand new thing is I'm going to butcher the name of it, but they brought about this benefit for people who are investing in buildings that are going to do direct manufacturing. They're going to allow 100% write-off of the building itself, not just the components of the building, but the building itself. And so if there's people out there syndicating deals to buy real estate that are going to be used directly in manufacturing, they have to do the manufacturing themselves. They can't be, as far as we've read it, they can't be renting it out to somebody else who's doing the manufacturing. But that might be a situation where an investor could have some hefty benefits in the right situation.
Yeah, it's interesting because we don't have a lot of clients that do manufacturing. They're mostly heavily in real estate. So I was having lunch with a client, and I just brought that up and thinking that that doesn't apply to you, right? Just do manufacturing. And he said, well, in fact, I was thinking of starting a manufacturing company to build manufactured homes. So that would be a really great example of how if you own the real estate under where you are doing the manufacturing, I mean, it's unheard of. 100% write-off of a building. It's not even depreciation, right? Just take the whole building. We don't need to do cost segregation. So that's something super interesting.
And it's brand new, and it's gonna take 6 months for them to come out and provide all the nuanced guidance and definitions and things. So it's kind of hard to say what qualifies, what doesn't. But it is interesting from that perspective. If somebody's gonna look for investors into their business, and they're going to have real estate inside the business doing the manufacturing, that could be a big benefit.
Yeah, that's huge, Alpha. I mean, very specific. How do you find or get into a deal like that? But
well, maybe you'll put together that deal.
That's right. Wow. Very, very helpful. Anything that we're missing that we should be paying attention to as part of the passage of this new bill? I think something that you just kind of mentioned here is, okay, first this thing goes through the House, then that goes to Congress, and then it lands on the president's desk. And then you talked about it's still going to take a while for a lot of the definition, the specifics to be worked out. Can you highlight a little bit more of that process? I mean, as a layman, my expectation was that once all of that stuff is figured out beforehand, before the president signs off on it, maybe I misunderstood you. Can you talk through about that a little bit?
Yeah, I mean, the tax world, everything gets down to definitions, right? So when we said, okay, well, we get 100% bonus depreciation back, but there's always anomalies, right? Because remember, the rule was you have to purchase after January 19th to get 100%. But what if I bought it in 2023? And I now put it in service. What percentage am I using? 2023s, or am I using this 40%? Am I using 100%? And so it's those types of things that there's not too much clarity or guidance, because when they sign something into law, they can't at that moment anticipate all the different anomalies that will happen, the different scenario modelings of what could happen. So those things tend to come out in the following 6 to even 12 months. When practitioners like us, right, people from AICPA will then and query these things like, okay, I get the law. What about in scenario A, scenario B, scenario C? And so, I mean, I think Matt's hopeful. If we're lucky, we'll get all the definitions in 6 months. Sometimes we don't, for a year or years to come. And those could be good or bad. If they don't give us definitions, then it's sort of kind of what your CPA could argue, right? If it ever came down to audit. So there's sort of pros and cons, in those scenarios.
And part of it also depends on, and too, is what aspect of the one big beautiful bill it is, like, hey, if we're increasing itemized deductions from 10 to 40 for state and local taxes and property taxes, that's been out there forever. That there's not a lot of definition and guidance needed there. But when they're bringing in something brand new, like a manufacturing deduction for 100%, I mean,
what's the definition of manufacturing?
When they finally sit down with Congress members who wrote it, or sit down with probably members of the practitioner community and the IRS for that matter, and it's like go through all the possible questions. I mean, that's where it kind of takes some months to work through everything.
So you're telling me that what happens is they put all this together, run it through the different houses and the president, they run it through ChatGPT. Then CPAs are advising. I mean, it's now law. You need to try and figure out how to strategically advise your clients, and then as questions come up, hey, what's the definition of, that's going through a process where that gets detailed over time. And then, I guess, like, how often is it, or what's the likelihood that, you were talking about that your CPA needs to defend something versus not. But can you, I imagine that must be really difficult for you as someone who's trying to advise clients kind of deal with.
I mean, thankfully, there's not a whole, most of these are not super vague, right? So if it's something that's not stated in current law, then what you look at is other similar case studies. So we say, okay, we don't have a specific example that's exactly the scenario, but here's something very similar, and here's how the tax courts have ruled in those scenarios. And so if a client is audited, then maybe for us, Keystone CPA's position will be X, and hear the different court cases we'll be citing because it's close enough in our mind. Now, you could be another CPA and you say, I totally don't agree with that, right? Because I'm looking at, XYZ case and that says something different. So that's the part where, with respect to taxes, tax planning, tax law, a lot of that is subject to interpretation. Not everything is black and white, right? And so when we have new law, there's often times when, we have to make a decision now, but maybe we don't have too much clarity in the law yet. So the investor is maybe taking a little bit of risk as well, right? Because we think it's a certain way, but in 3 months, they come on and say, oh, that's actually not the definition, that's where things could get a little bit dicey. But I think as long as we move forward with the best information we have as of right now, right? Because we don't want to stop building the business, stop investing because of, undefined things. You're always going to have that in the tax world.
Yeah. What is very helpful in just kind of understanding how the CPA's role and what they deal with, right? I think I have a lot more empathy for the process that you go through and you deal with when you advise clients. What is kind of tying a bow on that one big beautiful bill? I would love to kind of just orient now towards like what are common missteps that people who are investing in real estate as an LP, things that they misjudge or common mistakes. I mean, I think we've covered like, choosing the right operator or knowing how to do due diligence on them. But have you found that, a lot of investors just don't understand X concept until too late?
I mean, I think the thing that comes to my mind is that the investors don't understand the value or the importance of doing proper tax planning ahead of time. They're still, we can bang our head against the wall every day for, 10 years about this, but there's still people out there that wait to talk to their tax person until April, and when they're dropping off their information for some reason. Now they're telling them what happened last year, and it's like, well, there's maybe a few things you can do for last year, but they need to be having that conversation now. Like, here's what I've got planned. This is what my investments I'm planning to do going forward. I might be selling this, or this operator might be selling that. I might be starting this business. It might be whatever it is, right? It's have an open line of communication with your tax advisor so that they can do proper planning for you. And when we do planning, we're not talking about a Q&A session where you come to us with your questions and we answer them. We want to understand what your goals are, what you're trying to accomplish. We can drive the conversation that way by asking some leading questions and get to, okay, these are the actions that you should think about doing.
Yeah. And also too, people tend to think if I'm a passive investor, there's not much planning I need. There's not much I can do. But even from the perspective of, hey, I'm thinking of making this specific investment, what source of money should I use? Should I use my cash? Should I use my 401k that I moved to a self-directed account? Should I tap out the equity in my primary home and then use that to invest? And all three of those have different tax implications and potential tax benefits, right? So if you're a passive investor and you think, oh man, there's nothing I can do or I don't really care about it, I just gave you a great example of when you should be talking to your CPA. And unfortunately, a lot of CPAs who don't really do real estate extensively will actually tell clients like, hey, you hear about other people saving taxes using real estate, but you can't. It's not for you because you don't do it full time, because you have a job, because you make too much money. And when a CPA says that to an investor, what they're doing is they're just taking a tunnel vision look and they're just saying, hey, syndication might give you losses, but you probably can't offset W-2 income today. But what they're not looking at is, hey, well, I just got more cash flow that I didn't have to pay taxes on, right? Because the sponsor did accelerate depreciation. I had appreciation I'm not paying taxes on. And eventually, if the deal were to sell, all my accumulated losses offset my capital gains. And if I had more losses than gains, they offset my W-2 income. So I think, if you're a passive investor, you've been told there's no tax benefit, just understand that statement comes from a very narrowly minded or narrow view. And the reality is we all get tax benefits. For you, it just might be a little bit delayed versus someone who's actively in real estate all the time.
A point I would love to double click on here is similarly, I think as an investor, as your portfolio grows, there was a time where I never met with my tax accountant, and I was that person that would just file my taxes in the beginning of the following year. And, I don't really remember where on the journey it happened, but, it costs money to meet regularly with your tax accountant. But, and I think it's probably most impactful when you either start with a new accountant or you have a lot of new changes going on. You're setting up new businesses or entity structures or things like that. And there were times when I was meeting with my accountant quarterly. And how often, when you're a CPA, we're talking about you really should be meeting with your CPA regularly. What is your ideal preference? Does it change based on the type of client? What does that look like? And what are those conversations like?
It's really driven by the circumstances. So we don't necessarily require quarterly meetings with clients because for some clients, there's not much going on this past quarter on this specific date, right? So when you schedule those meetings is typically like at the convenience of the CPA. Whereas the better way to do it is to schedule meetings as you have transactions. So kind of like what you were saying, right? I'm meeting because I'm about to go into a new deal. I'm about to exit this deal. I'm trying to tap into the equity. I maybe want to partner with someone. These are all great examples of times when you should speak with your CPA. So we have clients that we don't talk to for 6 months or 8 months, and then we'll talk to them every day, 3 times a week because they're in the middle of a deal or they're getting ready to launch a deal. So, we're of the thought it's not about how frequently you talk to them. It's about talking to them at the right time where it becomes more impactful.
And sometimes it can be as simple as an email too. It's just to send an email to your CPA like, hey, I'm getting ready to do this. Anything I should be thinking about? And then then we can help you. Whether it's email and whether it's, hey, let's jump on a call because we got to talk through these couple of things that So it can be as simple as that too, where it doesn't have to take 2 hours, obviously.
I love it. Cool, guys. This was incredible. Learned a lot from the insights of from CPAs who not are only CPAs but do their own deals, are both active and passive, and just great to hear from your perspective. Where can listeners connect with you and learn more?
The best place for people to find us is on our website, which is keystonecpa.com. We have a lot of free resources on there, a lot of information people can utilize there. So I'd say people can check it out there to start.
Yeah, we actually recently wrote an ebook on tax benefits for passive investors. It's not on our website, so I'll send you a link thereafter, and you can put it in the show notes. We shared it at Best Ever Conference when we spoke there last time, so it wasn't actually public. But I'm also on Instagram on a day-to-day basis. So if you're looking for daily tax tips, if you can't handle 2 hours of tax stuff, you just want to, bite-sized chunks, you can also follow me on Instagram as Amanda Han CPA.
And running on that theme of the Best Ever Conference, putting it on your radar, the Best Ever Conference is happening again in February 2026, again in, I believe, Salt Lake City. So just putting that on your radar to keep in mind as you're planning for the next year. Also, if you are a passive investor and you're interested in looking for more or finding more real estate deals, you can grab those from my starter kit at passiveinvestingstarterkit.com. It's one of the best ways to see a ton of over 700 different 506c opportunities and with new ones every Friday. Again, here, this is the Passive Income Playbook, part of the Best Ever CRE Show. We drop new episodes every Thursday, so be sure to tune in each week for more conversations like this to help you become a better passive investor. And if you enjoyed today's show, please subscribe, leave us a review, talk to us on LinkedIn. Really helps us just reach more investors like you. And so with that, thank you for tuning in, and I will see you next week for another episode of the Passive Income Playbook.